Hello and welcome back to Full Circle with Shawn. I am your host, Shawn, and today we're back into startup pain and talking about valuations. So let's start with the concept of valuation. So valuation is basically the process of determining the current worth of a company or its assets. And there are lots of different methods for this. Some of the approaches are cost, market, income methods, and each different method really provides a different perspective on the value. So why should we get a value? Especially for startups, right? So we want to fundraise, and valuation is critical for raising capital. It determines how much investment startups can receive and how much equity they have to give up. Mergers and acquisitions, right? M&A. In M&A scenarios, valuations help determine fair price for what they're buying and ensure that the deals are fair, basically fair and balanced, right? Financial reporting. So for accounting purposes, accurate valuation is necessary for compliance and reporting to stakeholders. And then you have strategic planning. So by knowing your valuation, it can help you understand your company's worth, and that can aid in strategic decision making, such as when to expand or pivot. And then you have employee compensation. So stock options or equity compensation is pretty common in startups, right? But they need to be based on the company's valuation. And this can also affect recruiting and retention. And there are quite a few different stages in fundraising. So let's go over some of those in relevance of your valuation. So your seed stage, right? So the seed stage, the valuation is often basically proving potential more than actual financial performance. So the valuation primarily helps in obtaining initial funding from angel investors or early stage venture capitalists. And basically a higher valuation can reduce founder dilution, but you really need to be justified. And you can do this by, potential market size, the novelty of your idea, and even the team's capability. Series A. So in your Series A, it's you want to show you have a track record of user growth and revenue. Series A really focuses more on the growth potential and the ability to scale. And a solid valuation at Series A can attract established venture capitalists and provide the capital needed to scale rapidly, which really influences the stake that the founders retain post-investment. And then you have Series B and beyond, right? Because you have C, D, E, and if you look at some of the stuff on, say, Crunchbase, F, G, and so on and so forth. So Series B and beyond is more about your base valuation on clear financial metrics, market position, and path to profitability if you're not profitable yet, or further profitability. And valuation here is really critical for both negotiating further investment and setting precedents for potential exits, right? Because that's what we're going to do next. We're going to try to exit. The impact. So the impact of Series B and beyond, strategic valuation of these stages affects not only the investment terms, but also broader perceptions of the company in the market. And that can potentially influence partnerships, customer relationships, and even acquisition talks. And then you move on to your exit stage. So either your IPO or your acquisition. So the purpose of your valuation here, obviously, is to determine the market value of the entire company in the case of an IPO or acquisition. It's basically the culmination of all previous valuations and the growth trajectory of the company. And a robust and justifiable valuation can maximize returns for all stakeholders and end the startup phase on a really high note, reflecting the overall success and financial health of your business. So let's go over a couple of different valuation methods. The cost approach. This method calculates the value of a company based on the cost to recreate or replace its assets minus any liabilities. So it reflects the net asset value of the company. It's most useful for companies with significant tangible assets. Or for the valuation of, say, insurance or liquidation. And some of the limitations of it may not capture the true earning potential or market value of companies, especially those that are service-oriented or technology-driven with minimal physical assets. And then you have market approach. So the market approach determines a company's value by comparing it to similar companies that have been sold or are publicly traded. And this is widely used for valuing startups and mature businesses by looking at comparable companies and really analyzing and setting, what's the precedent in transactions. The advantage is it really provides a market reality check and is relatively straightforward if comparable data is available. However, it can be challenging to find truly comparable companies, especially for unique startups or industries with very few competitors. And then you have the income approach, right? So this really values a company based on the present value of its expected future cash flows. And this method accounts for the time value of money, discounting future cash flows back to their present value using a discount rate. And it's best suited for stable and mature firms with predictable cash flows. It is also used for growth companies with a clear long-term financial projection. One of the advantages is it focuses on intrinsic value independent of current market conditions. So this can make it powerful for evaluating long-term profitability. However, it's also highly sensitive to assumptions about cash flows and the chosen discount rate, and that can make it very complex and subject to estimation errors. And I mean, to be real, people like to overinflate or hope that opportunities are better than they are, which leads to this getting inflated anyways. Now, there are some factors that can affect your valuation, right? There's some internal factors, there's some external factors. So let's start with internal factors. Your business model. The efficiency and scalability of a company's business model will strongly influence its valuation. Revenue. So current revenue levels and historical revenue growth are really critical indicators to investors of a company's financial health and potential for future profitability. Your growth trajectory. So projections for future growth, including market expansion and new product lines, can significantly impact valuation. High growth potential leads to higher valuations. Then you have intellectual property. So your patents, your trademarks, your copyrights, they can have substantial value, providing competitive advantages and potential revenue streams through licensing or exclusivity. And then finally, the team. So the quality and experience of the management team and the staff are crucial, and because they drive the company's ability to execute its business plan and to innovate. Now let's look at some external factors. So industry trends, emerging trends, technological advancements, and shift in consumer preferences within the industry will affect a company's future growth prospects and, in return, its valuation. You have the economic climate, right? So broader economic conditions like interest rates, which we all know about, right? Inflation, which everybody's dealing with, and overall economic growth, they really influence the investment appetites and the perceived risks in order to invest. And that could really impact valuations. And then you have finally the competitive landscape, right? So the number of competitors, the market share, and the overall industry competitiveness can dictate how much a company's worth. Now, if we look at the investor perspective, when they look at a valuation, they look at a few things, right? So they look at realistic projections. So they seek valuations based on realistic, data-driven financial projections that reflect both the current market conditions and plausible future growth. They look for scalability of the business model. So if you can't scale your business, you're not going to be worth as much. So they look for people that can generate the exponential growth, but also scale. And then they look at market size and penetration. So valuations that are supported by accessible market size and clear strategies for market penetration lead to more investor interest. Then you have competitive advantage. Startups with a strong competitive edge, whether through technology, intellectual property, or even unique business practices, are often valued higher. And team quality. We've talked about teams a little bit. But a capable and experienced management team is crucial. And investors often bet on people as much as they do on the product or the service. So then we look at, well, okay, cool, I've seen their perspective, but how do they really gauge risk and potential return and tie that to valuation? So the risk assessment, right? So investors use a valuation as a tool to assess the level of risk involved in an investment. Higher valuations might represent higher expectations and greater risk. They look at the return on investment, right? So valuations help investors determine the potential ROI. A lower valuation can mean higher potential returns if the company does actually grow. Investment allocation. So by comparing the valuation with potential market growth and the competitive landscape, investors decide how much capital to allocate to a particular startup. And finally, exit strategy. So investors consider how the valuation aligns with their exit strategy, whether it be IPO, acquisition, liquidity events, basically assessing how the current valuation might affect future exit possibilities. So we understand investors, we understand mostly about valuations. What are some pitfalls that we all fall into when we try to value our business, especially as founders, right? Because we have the unicorn eyes, right? Overvaluation. Let's start with overvaluation, right? So what happens when we overvalue our company? We have capital raising challenges, right? An overvalued startup may struggle to raise further funds if it fails to meet the high expectations set by the initial valuation. We have investor dissatisfaction. So overvaluation can lead to investor dissatisfaction and trust issues if the company underperforms compared to its valuation. And then finally, we have exit problems. So high valuations, or at least initial valuations, can complicate future exit opportunities, such as sales or IPOs, if growth targets are not met. Then we also have the opposite of that, right? So undervaluation and missed opportunities. And what happens is, to start with, equity dilution, right? So if a startup is undervalued, founders and early investors may end up giving away way more equity than necessary, and it can lead to a significant dilution of their shares. And then you have attracting talent, because if you undervalue your company, it can be very challenging to attract top talent. And finally, perception issues. So a low valuation might create a perception of lower worth or lower potential, and it could really deter potential partners and investors. So what are some common mistakes that startups make during their valuation process? So the first thing is lack of proper financial projections. So you inaccurately or over-optimistically give your financial projections, and this can lead to unrealistic valuations. The second thing is ignoring market comparables. So look at the companies that are like you and how are they valued, and this can result in valuations that are out of step with the market. Then you have neglecting external factors. So not accounting for changes in economic climate, industry trends, or competitive dynamics can lead to misguided valuations. And then one that most of us founders kind of fall into from time to time, emotional pricing. So founders sometimes insist on higher valuations based on emotional attachment to their venture rather than objective metrics. And finally, we have inadequate negotiation preparation. So we enter valuation discussions without proper preparation or understanding of valuation techniques and terms, and this can disadvantage startups in the negotiation. So let's look at a couple of examples. So Airbnb IPO'd in 2020, and despite being in the middle of a pandemic, Airbnb achieved a successful IPO with a strong valuation because it really demonstrated the resilience of its business model and the potential for rapid recovery and growth. So we learn a lesson here, right? That it's important to be able to adapt and have clear communication of long-term value to your investors. And then we have Zoom, right? Zoom's market valuation increase in 2020. So Zoom's valuation skyrocketed as demand for the video conferencing surged, okay? It's the company's ability to scale operations then under pressure led to sustained increases in its stock price. And this really teaches us the value of having scalable technology and the ability to meet increased demand efficiently. Now we can look at a couple that didn't work. We have WeWork, and WeWork failed to IPO in 2019, and it initially had a value of $47 billion. And it failed due to concerns over its business model, over profitability and management issues. And what does that teach us? That the risks of overvaluation based on hype rather than financial fundamentals and the necessary of sound governance, which led their IPO to fail. We also had that medical one, right? It was Theranos. And basically they were valued around $9 billion. And once they faced legal and operational challenges due to fraudulent practices, they collapsed. And this teaches the critical importance of transparency and ethical conduct in maintaining a company's valuation and trust with investors. So if we go to the base of it, what do we learn from different case studies? We learn adaptability and market fit. So successful startups adapt quickly to market changes and clearly align their products with customer needs. It's the customer needs. I'll say that one more time. The customer needs. It's not what you want to give them. It's what they actually want. It's what they actually need. Transparency and trust. So maintaining transparency with investors and stakeholders is crucial for sustaining your valuation. Misrepresentations can lead to really severe repercussions. Scalability. So when you demonstrate the ability to effectively scale operations, this can significantly enhance your valuation. Sound governance. Strong and ethical leadership is vital for investor confidence and even sustainable company growth. And finally, financial fundamentals. A solid foundation of profitability or a clear path to profit is essential, and it could lead to justifying high valuations, and it could help achieving long-term success. Now that we know all of that, and we've seen what other companies have done, how do we negotiate our valuations? Great question. We start by using data and benchmarks, right? So we arm ourselves with relevant data, including financial metrics, market analysis, and comparables from similar companies. We highlight unique value propositions. So we very clearly articulate what sets your startup apart. Is it your proprietary technology, your market position, or even your growth trajectory? We prepare multiple scenarios. So we offer different valuation scenarios based on varying levels of investment and associated risks. And this will show how additional funds will drive our growth. And finally, we leverage interest, right? If possible, we generate interest from multiple investors, and this will create a competitive environment and usually it'll lead to better terms. And finally, I've talked a little bit about transparency, right? So why is that important? Why are realistic figures and transparency important? And it's really about building credibility. So realistic valuations enhance credibility with investors, right? Overinflated figures can lead to skepticism and breakdown in trust. And if you've overinflated your figures, you're going to be found out, because if you don't make those, they're there with you if they invested, and they're going to know. Sustaining relationships, right? So transparency and sharing information and assumptions that you use to build your valuations. And this can lead to more sustainable investor relationships. And facilitating due diligence. And investors are going to want to do due diligence, right? They're going to want to see your books. They're going to want to talk to everybody. So you need to provide clear and honest disclosure. And this will also help to expedite the investor's due diligence process. And most likely it'll smooth the path to funding. And we will go over more funding stuff, more into funding, more into investors, more into debt financing, because as a startup ourselves or early commercial, we do a lot of debt financing over investment, but we have done investment. So it's really where you need to sit and where you don't need to dilute as a founder. Sometimes you shouldn't, but then sometimes you should, and you should take that investment. So we will talk about all of that in a future episode of Startup Pain, because it's all about startups and the pain that we all go through. So thank you very much for joining me today on this episode of Full Circle with Shawn. The next episode will be on entitlement, and I look forward to chatting with you then.
End of the road, we've come so far. In the circle of life, with Shawn we're stars. From the depths of care to the force we go. In the twists of life, we reap and sow. Journey on through every phase. Find your strength in the darkest of days.